Hello and welcome. You're watching Closing Trades here on ET. Now, of course, it's a tough market as we know, but the pharma sector is in focus. Let's pull up the Nifty Pharma Index. It's one of those in focus right from the morning since the fact that US President Donald Trump has suggested that there will be zero tariffs on generic drugs till the 1st of August 2028, 100% tariff after 1 year, and 200% tariff or rather 100% tariff for a year after the 2 years and 200% tariffs thereafter. This applies only to generic drugs. As a result of that, you're seeing a knock on some stocks. Aurobindo Pharma, DRL, Lupin, Zydus, Cipla, Glenmark, Alkem, Torrent. Just some of those with US exposure. Even though several of them have US facilities, you still have that knock coming through. In fact, we spoke with a couple of management since the morning and most notably Granules India, and they suggested that it's going to be unrealistic to expect this to sustain. So broadly, that's the context of it. Let me in fact go across to Meryl. She's here with a perspective.
That's right. It's quite a major update for Indian pharma. Donald Trump has finally put numbers and timelines around his proposed tariffs on generic drugs. And while the immediate relief is undeniable for a few companies, the long-term challenges for Indian pharma as a whole is far from over as it seems. Here's why. Under the new plan, there will be no tariffs for generic medicines for the next 2 years, between August 2026 and 2028. But after that is where costs start to rise up very sharply. A 100% tariff kicks in from 2028 and that doubles to 200% starting from 2029. So now the question is 2 years enough time for Indian pharma players to prepare for this? Building a generic drug manufacturing plant in the US is not a quick exercise by any means. It can easily take 12 to 24 months and even longer if you factor in that volumes also need to be ramping up, especially after factoring in regulatory approvals and customer qualifications, which is all the more difficult to obtain in US compared to right here in India. That means that companies don't already have a US footprint. These companies may also not have the balance sheet to invest aggressively and could find it difficult to shift meaningful productions from India to the US before these tariffs start kicking in. And that is a significant caveat because US is India's biggest pharma export market. Nearly 90% of the prescription drugs dispensed in the US are generic drugs, and India exported roughly $30 billion worth of pharmaceuticals in the past year in FY25, and more than $10.5 billion, or roughly 1/3 of this, went directly to the US. Among pharma companies as well, Aurobindo Pharma, Zydus Life Sciences, Biocon, and Dr. Reddy's. These are some of the companies having the highest exposure to the US market, with nearly half of their revenues linked directly to the US. We've also got Piramal Pharma, Lupin, Sun Pharma, and Cipla with meaningful exposures to the geography as well. Now, the good news from this is that several large players, including Sun Pharma, Dr. Reddy's, Aurobindo, Lupin, Zydus, and Cipla, these players already have their manufacturing facilities set up in the US, which gives them a head start if local manufacturing does become a necessity going forward. However, not everyone is equally prepared. Biocon, for instance, has only recently commissioned a facility in New Jersey, which will take some time to ramp up, and a large part of Biocon's manufacturing is still dependent from India and Malaysia. The pressure could be even greater for more mid-sized companies, as apart from investing in new plants, they'll also have to deal with fresh regulatory approvals, rising construction costs, which is partly due to the higher tariffs on materials like aluminium, and also the time which is needed to ramp up commercial production once all the groundwork is laid down over there. So the takeaway from this all is that in the short term, while some overhang of a potential generic tariff is cleared for most pharma companies, but in the long term, that is the one to watch. The message of here is very clear. If the US does follow through with this tariffs, which is again a highly likely and debatable point on its own, but if it does follow through, then manufacturing in America will become increasingly important for these Indian companies, and companies with existing US facilities are likely to be better positioned, while export-only generic players could be seen taking the brunt of all of the costs associated with it. With it comes the cost of higher capex, margin pressure, and a more challenging road ahead for these players.
All right. Thank you so much for that, Meryl. Let me bring on board Nandan Kulkarni of Bernstein. He's Director, India Healthcare and Senior Research Analyst at Bernstein. Great having you, Nandan. Let me first start off. You've got a slightly different angle to this. You're saying that in general, there's been an underpricing in the generic market in the US, and this could well be the trigger which the industry is waiting for. First off, give us that perspective. And I'll ask you a couple of follow-ups. It's a very interesting one.
Sure. And you're right. I mean, everyone has been simply talking about the short-term triggers as cost and how much difficult it is to make in US and so forth. Number one, a few months back, we have already seen that the drug shortage in acute categories has already started impacting US markets. We believe this trigger is going to amplify it even further in the near to midterm. One of the drivers being any potential tariff conversation which tries to move manufacturing onshoring will require a massive ASP upside revision to be able to sustain the economics. Economics in terms of labor, economics in terms of running the plant, and economics also in terms of getting the site transfer and filing the product with the FDA with the new site. All of that is going to trigger an intense revision of ASP, number one. And number two, massive competition, which will unfavor the smaller players, barring the exits. And that shortage is something that we believe is going to be an important detriment for the US patients, and therefore will have a substantial, interesting earning opportunity as well for a large Indian biopharma companies.
And this, you believe, Nandan, is going to play out over the next 1 year itself? That's the indication I'm getting.
Roughly 12 to 18 months, because if you see from a broad headline, today we understand that maybe the tariff will come in effect after 2 years. However, the preparation or stage towards it will be set much ahead of time, number one. And that window is about 12 to 18 months. Number two, if the tariff really has to come through in that effect, over the next 12 to 18 months, the negotiations with the payers and the pharmacy benefits will start for every single company who wishes to operate in US market, including the ones who have the capacity in US. And therefore, these dialogues are going to take effect in terms of shortage, prices, newer market structure over the next 12 to 18 months, rather than waiting for the entire tariff to unlock after 2 to 3 years.
And therefore, Nandan, how should one look at, if at all the tariff were to come through, first off, the next 2 years? Will it be led by, one is of course supply chain getting ironed out, as you are suggesting, and the second is also stocking up, right? Because it'll be at the fag end of President Trump's term. Whether that tariff actually sustains or not will also be something which will be in question.
You're absolutely right. And I always give an analogy of a moving chessboard, right? So number one, some of these advanced stocking and what we call strategic reserves will start becoming more of a policy narrative even for benefit operators, the PBMs in the US. And that will actually be a short-term trigger for improved demand for a large-scale generic manufacturers. That's first number point. So it's a pent-up demand before some event is anticipated. Number two, given that this appears, at least from a prima facie, a policy at a broader sense and not any section-specific investigations, there is enough chance of litigations and legal battle following through. And therefore, any outcome which is against proposing such tariff will again favorably support Indian biopharma not to commit a substantial capex at the beginning to go and onshore the products. So it might be a strategy of stocking critical products getting onshored for some time to balance out the supply chain risk, and at the same time waiting and watching as it is the fag end of the term, as you rightly said, to see what are the real fallouts beyond the narrative in terms of policy implementation. So I think that's how the equilibrium is going to move. And last point that we also alluded in our report is it's going to accelerate innovation-driven value in US further, especially for the large ones who will start continued focus on innovation-centric drug supply, may it be 505(b)(2)s, orphan drugs, those are the pathways that will get further protected by the US FDA, and that is where the play will continue to double down. So I think that's how the variables are going to stack up.
Interesting. You know, I want to understand two things. Is 2 years realistic and enough for onshoring of manufacturing and rewiring of supply chains for some of the Indian players? That's one. And this is obviously subject to the fact that they should have the available cash to do the kind of capex that will be required. But let's assume that they have that. The second piece is who structurally gains therefore and who structurally loses. If you can give us some color on that.
Certainly. Number one, in the report that we explained, I think 70 to 80% of generic volume that is in the US market today is simple tablets or solid orals in a technical term. Onshoring that is relatively a simple task compared to complex injectable or complex generic products. Now, at the same time, these 70% products are also operating on extremely thin margin. And therefore, beyond the cash, the question is sustainability of those operations on US onshoring, irrespective of who is trying to do it. From that perspective, companies such as Sun Pharma, Lupin, Zydus, who are actually present on the US soil today and having running certain plants at certain capacity will find it incrementally attractive enough, number one, and number two, reasonably fast pace to do certain select tech transfers. And I believe within the 2 years, that is a reasonably achievable task, given last 20, 30 years of rich legacies that Indian biopharma and these companies have been operating in this market. So from that perspective, structurally, I like these stocks as Lupin, Zydus, Sun Pharma, who have this presence ability, and the 2 year time frame seems to be sufficient for these simple generics case by case basis. The second broader question to you on who might be in a not so perfectly well placed end, one of the answer, of course, is to contemplate about Biocon, because biosimilars by nature is not so straightforward as a business. Site transfers are more time consuming, rewiring supply chains are not easy, and Biocon's presence on that large category as of today is more centered from supply from Asia. And those will be a little bit challenging to navigate if the policy has to really material into tariffs in the full form that we are seeing today. So that's how I would look at the stack at this point of time.
Nandan, will the US digest this kind of tariff? Because there has to be, it's not realistic to expect Indian companies with niche products where you may not have alternatives in the US in terms of the supply to be saddling 100% duty. In that case, do you believe that some burden will actually get passed on to consumers in the US, which will actually put pressure to the fact that this entire rhetoric of tariffs on the pharma industry and generics is unsustainable? Right.
I think that's an important policy question, which of course will get debated over the next 12 months. As I said, once the pharmacy benefit managers, the PBMs, will start a rolling new wave of acquisition packages. But number one, certainly there will be a substantial portion, we believe, that will get passed on, given the margins are so thin in many of these categories that manufacturers will have no choice but to exit the market, which is not a win-win outcome for anyone, including the patients and the US FDA. Number two, in the pass on of these costs, out-of-pocket cost that will rise will also be kind of the factor that will have to be considered by the policymakers. And number three, therefore, most likely fallout that if may have somebody has to telescopically look at it, maybe selective tariff policy, as what happened in the MFN policy for branded drugs, or company to company contract signatures where certain products are incentivized selectively to be onshored at a company level rather than a blanket or a complete basket. So I think those nuances will start emerging, but there will be certain cost to the consumers that is inevitable if tariffs of this nature in this form today were ever to be conceived. That's our broad view.
And just talking about some stocks, right, Nandan, difficult to avoid counters and go stock specific, Sun, Zydus, Lupin, they all have facilities in the US, right? So they're far better placed.
Right.
Who's the best place to kind of capture market share and take opportunity from everything that's playing out, if at all tariffs were to be implemented, of course?
Right. I think if they were to be implemented, there is a manufacturing lens where I think we like these names. But beyond just the manufacturing, there is also an element of managing the channels in the new tariff era if it had to come. And that will pretty much depend on ability to go grassroots in terms of market, create a differentiated branding positioning. And I think that's where Sun is going to have, in our view, a substantial, a good head start, given its massive organon acquisition, which gives it a very strong footprint in the US in terms of channel and channel synergy, a good basket. And therefore, I think Sun will be one of the important and best placed stock to kind of play on this momentum in terms of reach out to the market.
Large one is obviously Aurobindo, Nandan.
Right.
The understanding is you're neutral on the stock, but give us a sense if I've got that wrong. And what would it take for you to get more constructive with regard to an Oro? Give us a sense.
I believe Aurobindo has been doing phenomenally good job as a company to supply a massive amount of generic volume to the US and Europe for the last many years. And one of the important company to have built structural chemical setup with backward integration, serve those markets where pricing is, as we said, very tricky. That strength is definitely going to be an important catalyst for Aurobindo in the case of tariffs, especially given that now they have Lanet in their basket in terms of manufacturing and then a large manufacturing facility back in India. I think they are one of the important lead runners to speak on doing things faster, taking it to the US market on your form of tariff. However, one of the only caveat where I would be a little cautious on Aurobindo is ability to turn around products on time, which has been a consistent problem and observation. So I think while there is a manufacturing capacity, a time to realize it in the market on time, getting that basket approved with consistency is where it's a continued struggle in some sense. And once that system gets bottom up transformed, once we see more of first time right products getting approved in ANDAs from Lanet or some of these facilities, I think that will be a good important point for Aurobindo to kind of transcend into a new category of a specialty complex generic player. So from that sense, the view is little neutral, positive sides, but little bit cautious on execution part from quality sense.
Nandan, we spoke with the management of Granules. They seemed very comfortable. Now, Granules is a company where nearly 50% of revenue comes from the US, right? And therefore, there's that dominant US revenue. But they seem very comfortable. They're saying we will pivot. How easy are some of these pivots in terms of having a US facility, diverting some of India production to the US, expanding the US facility, capex, balance sheet, and the like? How should one think of those pivots, if at all Indian companies have to make it?
Right. I will give you my comments more as an industry expert because the stuff you mentioned is not yet in my coverage universe. But having spent significant time in the industry, there are two important observations or insight. Number one, as I was explaining, the solid orals to be one of the predominant categories, 80% by volume on these generics. Majority of these transfer require a simple batch structure, in vitro data, and an increased ability of in vitro in vivo correlation. I think those three things broadly are well placed for Indian biopharma today in a larger sense. Given last 20 years, we have been navigating US FDA policies. We have been making batch after batch. We have seen the recalls and then continuation of quality programs. So from that lens, my comfort is that Indian biopharma's intrinsic ability to navigate tech transfer is far superior today. And that's the confidence that I would get for an industry lens. That's number one. Second, my comment from industry perspective will be that when you think about balance sheet, majority of this capex we believe is going to be incremental in nature and therefore partly supported by these ASP revisions that we were speaking about. So when the new waves of manufacturing-driven supply will come in, assume a post-tariff era, I think the newer ASPs, because of the shortage, will start kind of funding some of these site transfers. And I think that is a catalyst which gives comfort to many managements moving forward that A, we know how to do it, and B, the cash is not going to be fully strained and consumed from the balance sheet alone. There is certain element of market rewarding to do so. And that's where the comfort will start coming in.
Last off, Nandan, if we're sitting in 2030, do you believe this is actually a positive catalyst from an Indian pharma standpoint or negative? And therefore, by extension, is the fall today an opportunity to actually go out and buy from a 3-4 year perspective?
I believe this is a very positive catalyst. And it is on a very two different dimensions why it is positive. Number one, it's going to hardwire Indian biopharmas to continue to be on the path of operational excellence in these uncertain world of supply chain, which makes balance sheets healthy, adoption of technologies, digitization, AI much improved. That was our view for last many months. And therefore, it brings better rigor on generating margins. That's number one in terms of positivity.
Please
Number two, as we have been vocal, Indian biopharma is pivoting towards innovation, a very different incremental innovation. And this catalyst is going to accelerate it even at a policy level, like 505(b)(2)s, orphan drugs, complex injectable, peptides. All of those capacities and associated strategies will start getting renewed and fresh view from the management and from execution standpoint. So when I extrapolate all of this in 2030, our view is Indian biopharma is going to compound in terms of its innovation-driven earning, and this trigger may actually accelerate it rather than decelerate it. So I believe it's a very structured way to be along on this sector as a whole, and that's our view consistently for last many months.
Excellent. Thank you so much, Nandan. Thanks for joining us, giving us that perspective. Long chat. Thanks for taking on the time. All right, time to switch focus though. Look at the larger market, right? Vinod Karki of ICICI Securities will join us immediately post a very short break. So we need to slip into a very short break, come back. Vinod, thank you so much for very patiently waiting by. I'll come straight to you post the break, please. Thank you. Hello and welcome back. You're watching Closing Trades here on ET Now. We're joined by Vinod Karki of ICICI Securities. Great having you here, Vinod, and thanks so much for waiting very patiently. But that was an interesting conversation which I just couldn't let go of. Vinod, I'm sure this one's also going to be equally interesting. How do you position yourself in a market which is where there's so much sector churn, so much sector rotation? You're, of course, an equity strategist. And you understand macros plus flows plus earnings, all of it together. So give us a sense as to how you're looking at the picture.
Yeah, thanks. And yeah, that was an interesting discussion I was just listening to, which you were having earlier. And some of that connects to what I'm going to say. So first of all, one thing which is happening, I mean, so there's several moving parts here for the market. One, if you look at the positives, the big one is that, after a scorching couple of years of massive, bull run in the AI infrastructure stocks, finally we are seeing that fizzle out. And what was happening because of that was that India was losing favor because India was not giving those it did not have any AI play, and the growth was not looking that good relative to some of these asset classes. Now that seems to be that hot market is developing some fatigue, it seems. So from that perspective, I think, and as simultaneously what happened during this quarter is that if you look at the inflation numbers, it started to pick up. And while inflation is picking up, the productivity in the economy in terms of volume growth, we saw a lot of some of these auto companies and others, cement companies, the volume growth and the productivity in the economy has not suffered due to the West Asia crisis. So if you combine decent productivity growth in terms of volume and add to it that inflation has started to now rise, you will be getting some good double-digit nominal growth, which will again get translated into good earnings growth. So this combination of nominal growth finally picking. So what has happened in the last couple of years? One was this AI boom, and we missing the AI boom. Plus, our nominal growth was in single digit, and now both are turning. So that's why you are seeing some element of the FIIs started to return to some extent, at least. At least the selling has gone. I mean, it's lesser, and we do see sporadic buying here and there. So I think that is a good thing. Well, but we again see the resurgence of the West Asia crisis again. But to that logic, we have a longer-term view. What we we just released a note yesterday talking about this, and which says that over the last decade, and starting from 2016, which was the period where the Brexit vote came in, and Trump's first tenure, which started this whole tariff thing, and then the pandemic, and then the Russia-Ukraine war, and then the Trump Part 2, and now the West Asia war. We are seeing an environment of elevated geopolitics, and which has these military conflicts plus the economic policies which are inward-looking. Each country for itself kind of thing. So I think this is not going away anytime. So if we try to think in a way that let's say the West Asia war will get over and everything will be fine, something else will come up. I mean, we're already seeing some news on the tariff, which you just speaking about on pharma sector earlier. So I think this is a new world era in our view, where from the free trade era, we are moving to this inward-looking policy era, where this will be an ongoing thing. It will not settle at something that something gets fixed and it's settled. Something will keep cropping up time and again. But at the same time, what you have to realize is that during this decade, the global trade to GDP is actually at an all-time high of around 68%. 2016, it was around 54%. So what it says is that the global economy finds its way around these kind of inward-looking policies, high elevated geopolitics. All that is fine, but trade finds its way around it in various ways. So we think that this environment itself gives opportunities to a different type of. So if you see from the pre-COVID time till now, the stocks which have really and sectors which have really taken off are in the capital goods sector, in defense, in manufacturing, in some of the auto companies, some of the financial services which are related to capital markets or corporate lending, PSU banks, and those kind of things. So I think this new economic environment is throwing up new winners in our view, and the market participants have to actually focus in those areas where this new era will actually throw up opportunities.
Hi, one of the arguments for flows was the growth and earnings growth for the Indian market. Given the kind of numbers we have seen, and the anticipation was that the financial services will be performing much better compared to others. We haven't seen that kind of spark coming in from the private sector so far. How do you look at the financial earnings growth in that background?
So, see, the financial services having a unique problem. I mean, if you look at the top line growth, I mean, in terms of credit growth is now almost 18%. So I don't think if you just look at it from a demand perspective of credit growth and all, I don't think there is any problem. The problem is largely to do with the NIM compression cycle. I think it's at the fag end of the whole cycle. I don't think rates are anyway. I mean, in this environment of inflation rising, going to fall further. And but the NIM compression is still there to some extent. But the larger picture is that that the credit growth is quite robust. I mean, if you look at the credit growth last year, same time, it was almost at par with the nominal GDP, which was at around 9%. From 9%, it has moved to 18%. And as per the RBI's latest data point, the NPAs are at a record low, multi-decade low level. So I think the margin angle is fine and well taken. But if you were to project forward, if you are in an environment where nominal growth is going to pick up and credit growth is going to be strong and inflation is rising, typically NIM compression cycle would be something which will not hamper growth in earnings going forward. So yeah. And we also saw at the PAT level, in fact, most of these large banks do pretty well, despite the NII growth not being that well, because NPAs were low and provisioning was low. So at the headline Nifty level, actually, the profit growth for some of these banks was pretty healthy, almost 20% thereabouts, some of these banks. But obviously, the NII growth was not good and the NIM compression angle was there. But from a NPA cycle or a credit growth cycle or the corporates releveraging cycle or the CAPEX cycle, I think things are looking positive overall.
How should one, what sectors or segments are looking interesting? Obviously, there's been a bit of a value unwind which has already happened, from the lows of March to now, right? So that re-rating seems to have happened to some extent in terms of multiples. But where will earnings growth velocity outperform what the street is currently penciling in what sector segments? Or where is it that there is still some value unwind left to kind of tactically play some of those sectors or spaces, if you can give us a sense?
So I think stocks, performance usually, chases growth wherever growth is picking up. I think clearly in this environment, which we talked about, the areas where growth is looking pretty good, be it capital goods, defense, manufacturing, in discretionary consumption, be auto, retail, and some of the other discretionary consumption areas, the growth is pretty very good. And in terms of the financial services, the banks and all we just talked about, I think that's an area where still the concern on margin is keeping a lid on the stock performance. But I think that the credit cycle is picking up along with nominal GDP growth and the CAPEX cycle. So I think that remains an area where the valuations are still quite reasonable. Commodities, I think, also should do well in this era of inward-looking policies, shortages, and all those kind of things. So that area should also do well. So if I were to bucket them under three areas, I would bet on the industrials, the discretionary consumption, premiumization area, and the financial services where growth is picking up.
Vinod, interesting that you've taken discretionary spend and financial services as well. But over and above that, is there any sector which is now a safe haven for investing, given the fact that almost every company or which are coming out with earnings, there is an imprint of the impact of West Asia on them, on the margins for them. Which are if you are going to look from a year or two perspective, which are the companies which would continue to do it, and it's between the asset classes like a mid cap, small cap, and the large cap, where would you look for growth?
Yeah, so if I look at from a asset class perspective, large, mid, small, clearly what we are observing is that some of the mid companies are actually giving higher growth than the large caps for sure. So, but at the same time, when I look at their valuations compared to their larger counterparts, they are not cheaper. So that valuation premium is there. So it's not a case where you will have cheaper valuations and higher growth. it's kind of setting off to some extent. So I think growth-wise in general, I feel that the small cap, mid cap space may generate higher growth. But markets are pricing in higher valuations already to some of these stocks and sectors. So yeah, so you'll have to live with that. That for growth you'll have to buy it a little expensive, and wherever you finding cheap valuations, growth is a concern. So market is not leaving anything free on the table. There's no free lunch over there clearly. What I do see is that because of financial services and banks, as I said, is a situation where structurally in the economy we are seeing the credit growth pick up, but it's not kind of reflected in high valuations of high performance and high valuations of at least some of the banks. I think, but from broader macro perspective, things are looking good in terms of record low NPAs and credit growth picking up, and the NIM compression cycle at its end, and valuations not at peak. So it is leaving some room for comfort for investors to not go wrong in that area.
Vinod, it was a pleasure talking to you and getting a perspective on where we are, especially in this uncertain times. Thank you very much for joining us today. That was Vinod Karki of ICICI Securities. We'll step into a small break and we'll come back with markets which are getting weak, 23,980 at this level as we speak. And there's some pressure coming in from IT and Nifty Bank.
Welcome back, and thanks for staying with us. We're joined by two technical analysts this afternoon. We have Kunal, of course, as always, in studio, and we have Himen as well with us. Let me start with quickly highlighting that there's pressure across the board in markets today. 0.9% lower on the Nifty, so clearly, evidently pressure there. But today is a little bit different insofar as you're seeing pressure even on the broader markets. So you're seeing the small cap as well as mid cap indices under pressure. You're seeing IT as well as banks under pressure. Kunal, it's not looking pretty. Any silver lining?
Yeah, I think so difficult to say a silver lining, but we've broken below some crucial barometers today on the indices. We've broken below the 24,000 mark. The bank Nifty is on the verge of breaking 57,000 levels on the spot basis. You're looking at the market breadth, almost 1:5, 1:5.5 in terms of the advanced decline ratio, more in favor of declines, of course. So that, I think, is not a rosy picture for the indices. And that too, I think, coming on the expiry week, or the week where the market is going to the expiry, is a bit of a kind of a mixed signal. But then broadly, when you go back 5 weeks or 6 weeks back, we've been trading into this band of 500 points broadly for the Nifty, 23,750, 800 as a support, and 24,300 approximately as a resistance. So when you look at this on the day-to-day basis, yes, this 200-point drop on the Nifty looks to be a bit concerning. But then when you go back and look at over the last 4 or 5 weeks, we have been trading into this band. So maybe I think it's just about a routine correction for the indices.
Himen, how do you look at the Nifty breaching the 24,000 mark? Do you think with this we're going to see some kind of profit booking at this level now?
Hi, very good afternoon. Thank you for having me on the show. Like Kunal mentioned, 23,800, 24,588. This is a 26th trading session in this range. We've gone nowhere. The VIX has been consistently below 14, which is good, but that hasn't resulted in any upside. So yeah, if 23,800 breaks, from a closing point of view, I think that would be a spot of bother. Otherwise, we've gone nowhere. It doesn't look like going on anywhere. Brent is $94.5. The rupee dollar is what, 96.50, 52, 54. That's at highs. So if crude and the dollar remain like this, equity markets aren't going anywhere. So nothing has changed yet. But I'd repeat, if 23,800 breaks, I think we lose a few hundred points in a jiffy. But we need a closing, and that still doesn't look like happening.
What kind of trade you going to do in this market? Picks?
So no trade on the indices, frankly, because I think we're stuck into this 500-point band, 26 days, as Heyman was also saying. We were discussing this in the morning, that it's almost fifth week where the markets have been stuck into this range. It's difficult to initiate any index trade. But yeah, stock specific, there are individual names which start to look attractive. Balrampur Chini, I think, is something which has come back on the radar in terms of a potential breakout above 600, 620 mark, where the stock is trading right now. So that could be one stock which I would believe could be a good bet at the current level. 680 is where I would place a target for the stock price, stop loss at 590. The second would be Adani Power. Even this stock, I think, is trying to make a comeback. The mean reversion seems to have completed for the stock around 220 levels. Risk reward attractive. Would look at a target of 238, stop loss at 208.
Okay, plenty of breaks, unfortunately, that we're going to have to take over the course of the next maybe 15 minutes. Need to slip into one, come back, take that breather, come back, ask Heyman for his stock calls. If it's not a nifty market, then it's a stock specific market. We'll take those calls on the other side.
Welcome back. You're watching Closing Trades, and numbers are coming thick and fast. You have now the SRF numbers coming in. Profit up handsomely. Revenue is up at 5,000 crores. It's up 31.8%. And if you look at the profits, it's up over 70% in today. That's for the first quarter. EBITDA at 1237 crores, and profit 759 crores, up 75.7%. And the stock is down nearly 2.9% in today's trade. So a lot of stuff is happening.
It's a beat on expectations. You just asked me whether the numbers versus expectations. Versus expectations, we had an EBITDA estimate of around 918 crore. The EBITDA number has come in at 1237 crore. So it's a very sound beat, frankly. And the PAT number was expected to come in at around 515 odd crore. It's a very, very solid beat. I'm just going to quickly compute the margins and try and give you a sense as to whether it's a margin beat or it's a margin miss. That's probably one of the factors which we need to quickly consider before we take a call as to whether the stock has moved in the right direction.
The stock is reacting negatively after the numbers, so it seems that the street was expecting much more from the numbers there for SRF there. So
maybe some part of it was built in, Sajid. The run-up also has been good. 21.5% was the margin estimate. It's coming at 24.5%. So it's a clear beat in that sense in terms of the numbers for SRF. Also, if we can pull up maybe the 3-month chart on SRF quickly. Kunal, what's it looking like on charts, SRF?
Yeah, the stock had been stuck into a trading range. We were looking at 2,700 as a support for SRF for the last 3 months, 2.5 odd months. And on the upside, 2880 as a major band of resistance. So it looks like the stock has now come back or revisited this range. We really need a breakout above those 2880 mark for SRF for the stock to call in, for a major reversal on the upside. There were shades of, intraday breaks or intra-week breaks for the stock above those levels, but we've yet to see a major close above those levels. So we'll wait for a point where the stock closes about 2,900 mark. That could be a good zone where the stock may indicate of coming out of this major consolidation band.
Okay. Heyman, just want to quickly try and also address some of the other earnings which have come our way. There's Mahindra Holidays. The stock is down 7% on the back of that, on the back of those numbers. There's iFinance, which has been a big mover, right? Both ways. I mean, on the way up as well as now on the way down. What's happening on a couple of those counters, if you can give us a perspective?
Harsh, Mahindra Holidays has been in a downtrend since the last 2 years. Nothing has changed. It continues to post lower tops, lower bottoms. Still, we don't stabilize, form a base, see a reversal come in. I don't think it looks like doing anything in a jiffy. So the weakness continues. Yes, there is a swing low at around on the 4th of June at around 208. Now that is going to act as a support, I believe. That breaks, we see another 7-8% gone. So nothing changes. Was weak, is weak, remains weak.
And what about BPCL? Very quickly, Hemin, on charts.
Sorry, can you repeat the stock?
BPCL, because those numbers also coming our way.
Well, I wouldn't like to second guess the numbers, but on technical parameters, we're in an ascending triangle. 320 is important. We need a weekly close above this. There's also the 55-week exponential moving average. Downside appears limited, but yes, if it's a result day, I would avoid saying anything. But yeah, but we need a close above 320 on the weekly chart if things are going to improve. As of now on charts, it looks more positive than negative.
Negative. The numbers look quite good, frankly, BPCL, versus what the estimates were. We need to slip in a very short break, come back, continue talking. Lots of stocks to focus on. We'll come back and continue that chat with both Hemin as well as Kunal. All right, welcome back. And, some of the banking names in focus. Kunal, would you play a trade on any of the banks at this point of time?
Not really. I think only IndusInd Bank is the one which is strongest of the lot, specifically in the larger cap names so far. The second is, of course, ICICI Bank. That's a stock which has been holding on to that 1400, 1440 levels. The only two names which so far are the stronger ones in terms of the private sector banking stock. So if I have to take a bet, I would probably prefer, taking a bet over here for these two names or either of these two names.
Okay. What about some of the big movers of the day? And Hemin, I'd love your view on something like a Bandhan.
Well, it's, frankly speaking, tremendous underperformance, Harsh, if you see. I mean, the performance has been abysmal. It peaked at a high of 741.80 in August 18. And now we are 8 years down the line. The bank nifty has made a new high. Many of the banks have made all-time highs. And this stock continues to go nowhere. Just when things were looking good, and there seemed to be a longer-term turnaround at play, here it gets hammered once again. There's a big bearish gap. It's going to provide resistance. I think one should avoid this stock because after 8 years, if he's doing nothing, I don't know. It's like waiting for Godot. So it's weak. And I mean, only a monthly close about 210, 220 would mean there is some spark in life and the first technical green shoots come in. Harsh.
You know what? I was reading a note by Suresh Ganpati in the morning by Macquarie on Bandhan Bank. And he made an interesting piece, okay? Maybe you should listen in. And he wrote that there are a lot of hedge funds which are actually going long at 160 and short at 200. And they're making a lot of money on Bandhan. So I'm trying to understand whether that trade is actually at play. Kunal, you have a view on that one?
See, it's difficult. I mean, after today's 15% plus kind of a downtick, we may attribute that 160-200 band is playing on. But in just few days back, the stock was about 220, 210, 15 levels.
Yes.
So that band theoretically would have been broken, of course. And, it's not a margin of 1 to 3%. It's a margin of good 5, 7, 10% in that case. So difficult to say that, in such kind of a sharp downtick on the stock prices, we expect that the stock price remains into a downtrend for the next 1 to 3 weeks at least. So no buy trades on the stock as of now.
Okay, all right. In fact, we spoke with the management of Bandhan Bank, and they said that there is pressure, and he sounded also a bit under pressure, right, Sajid, when we spoke with him. And stock obviously has tumbled 17%. Credit costs was one of the possible disappointments. The other one, and more importantly, was the ROA guidance. From 1.6 to 1.8, he's trimmed it to around 1.4. In fact, listening to what he had to say.
Probably sequentially, if we look Q4 to Q1, this is the quarter where we have actually reduced our slippages in the EEB segment. That is a great thing, you see, because the highest provisions come from the EEB segment because these are unsecured loans for that. And we have been able to reduce it. You see, there is a marginal increase in the gross slippages compared to Q4, this Q1, but there has been a reduction in the overall net slippages because our cash recovery was much more. This has been due to one ARC sale we have made, and also the other cash recoveries plus other NPA management decisions that we have taken it for that. Overall, I can see the credit cost has come down from 2 to 1.8, and sequentially it is coming down. You see, we at one point of time we had a credit cost of 4.5. From there we are now coming at 1.8. And I can say that if this continues internally, and unless there are some external factors beyond our control, this improvement will definitely go on for that year. So,
okay, all right. By the way, Eternal's numbers just coming up in a minute. I'm just pulling out that number. The top line number has come in at 20,211 crore. It's a 1% beat on the top line. I'm going to also quickly pull out the profit. Okay, so PAT at 92 is a miss.
Versus 174
versus
quarter on
174
quarter.
QOQ is surely looking like a miss. We'll have to look at the internals of this one. And of course, you'll very quickly start to see those numbers trickle up on your screen. There you go. You already have it. And you're seeing a bit of a knock on the stock. But I'll stick with Eternal. Kunal, would you trade this one at all? And I know that there will be some bit of volatility over the next few minutes or maybe even the next hour or so. But from a structural standpoint, would you go out buy Eternal in around the 270, 280 kind of levels?
See, the only concern is that with that slight bit of volatility, sometimes 30% to 40% for Eternal. So it's not very, small by magnitude. We've seen this twice, I think the last 2 years, where the stock had crumbled up, I think 30% from one quarter post results towards the next, 1 to 3 months. So, this is a stock which I think is a, kind of a special sit stock for traders who are looking at results as a key factor or an inflection point. Then I think it makes sense, but then you'll have to have a high risk appetite over here. Difficult to call in any kind of a trend as of now.
Devang Mehta joins us from Spark Capital. Devang, how do you look at Eternal I know you may not have seen the numbers because they're just out, but from a fundamental point of view, how do you look at Eternal?
I think thanks for having me on the show, Sajid. It's always a pleasure. I think honestly, we don't like this space much, to be very, very frank. This type of companies which used to burn cash, and of course, we know they are now profitable, some of these companies. But honestly, amongst the discretionary consumption candidates or candidates which are moving towards premiumization, we like a lot of industries like travel, tourism, or in fact, even the auto companies, the typical auto companies, the luxury watches and jewelry as a segment. But we generally tend to run away from companies like Eternal or its competitors. So we are not very bullish here, but we like companies in the discretionary consumption space.
Devang, aside of Eternal, the biggest casualty for the day, Bandhan. What's your view on that, if you have seen the numbers?
I think, typically, again, as I said, I would not be stock specific, but to be very fair, we had a stance of not holding on to banks since long. And again, it's more a trade where everyone is, it's a consensus trade that banks are cheaper at this point. But to be very honest, if you look at most of the numbers, yes, there have been certain remarkable numbers like ICICI Bank or certain PSU banks. But apart from it, it's generally been disappointing. And that too, even a mid-cap. Having said that, yes, a lot of these banks have started to become cheaper in terms of valuation. valuation, but how cheap they would become over the next 3 months, 6 months is anybody's guess. So we typically ignore the larger banks, even in the smaller banks, but we are more into financials, quasi-financials, the financial candidates like wealth management, depositories, exchanges, AMCs, broking houses. I think this is where a lot of money, probably banks can from here on compound at 12, 13, 14%, whereas this companies or this entities can compound at 18, 22% over the next 3-5 year period.
Just hold on to that. We have Gaurang Shah also joining us. Gaurang, you've seen the numbers first for Eternal. The quarter-on-quarter profitability has come down. The food delivery business on the quarter-to-quarter basis is up only 13%, 13%. QC is, or quick commerce is up 18.4% on a quarter-to-quarter basis. What's your first take?
Well, so firstly, with all disclosures in place as per SEBI's guidelines, and good afternoon to all of you all. Blank disclosure, we have a positive coverage on Eternal. Food delivery platform has not delivered. I think there could be a couple of reasons. First could be of course, the reduction in the fees of gold membership. Point number one. Point number two, the kind of delivery pricing that was there earlier has been brought down to, I think, about 100 rupees, if I'm not mistaken. Earlier it was about 190 or about 200. Because of that also there should be a hit. QC, that is the quick commerce that is done well. This is where we expected the company to do well. And as per the last financial year, fourth quarter verbatim given by the management, they are increasing the dark stores. They are going into tier 2, tier 3 cities. They are increasing their footprints. They are increasing their market share and thereby increasing their subscriber base as well. So possibly a little bit of more insight from the management as to why the food delivery platform has gone a little bit down would throw in a little bit of, maybe they have put in a little bit of capital on the capex that they are planning as far as the dark stores are concerned. Overall, we expect the company to do well over a longer period of time. And as I mentioned, we do have a positive call on it.
In fact, food delivery has been a standout in terms of numbers from what I'm seeing it. You've got adjusted revenue at 3,537 crore, which is a 33% growth YOY. So you're seeing some good numbers come in on the food delivery side of things. When you're looking at even the food delivery margins, it's coming at 5.6% odd of NOV, which is the adjusted EBITDA number versus NOV. Quick commerce has delivered an NOV of around 17,132 crore, which is also strong. And EBITDA is adjusted EBITDA is around 0.6% at 264 crore. Gaurang, just trying to understand, therefore, when I'm looking at the numbers, quick commerce, the adjusted EBITDA number looks slightly softer, you reckon, versus what the expectation was?
A mild softer, Harsh. I don't think there should be a big concern on this number as far as QC is concerned. And with the kind of stores that they are planning to open and the kind of presence that they are going to increase, my guess is that in the next 2 or 3 quarters, you should see incremental contribution coming in from QC, that is quick commerce.
Let me go across to Ashesha. Gaurang, please hold on. I'm going to quickly go across to Ashesha. She's here with a roundup of the numbers to try and give us a better perspective. Ashesha, how are you reading the numbers?
Well, yes, since we were talking about the segment-wise performance and Gaurang was just talking about the quick commerce segment, let's start with that itself, where the revenue this time around has come in at 15,664 crores. That's for the quick commerce segment versus expectations of about 15,700 crores. So a slight miss, or we can say largely inline set of numbers. But yes, of course, store addition is another parameter to watch out for. Now, as far as the going out business is concerned, we were expecting 297. It has come in at 318. So again, that is a positive. Food delivery business has been largely in line with what we were working with. And on a sequential basis, we have seen some growth for the food delivery business. 13% growth is what the company has reported for the food delivery business. And Hyperpure business has also reported a strong 6% growth sequentially. So when we look at the numbers on a sequential basis and when we compare the numbers across business segments, most of them are largely in line. There is no major miss as such. Of course, on the bottom line, there is a miss and we'll try to understand what went wrong on the bottom line. But on the revenue front, it looks largely in line with what we're working with. We, of course, are awaiting much more commentary that will come in from the con call later today in the evening.
Just to add some color to the numbers which have come in on the adjusted EBITDA, in Q1 is around 172 crores and compared to that, 555 crores on versus 172 crores YOY. While on a quarter to quarter, it's gone up from 429 to 555 there. The treasury gain has been around 311 crores for them. The cash burn is around 486 crores. The surplus is 486 crores at the end of Q1 for them. So the surplus has gone up on a quarter to quarter basis for them in that sense. So that's something which is coming in, and closing cash balance, they're sitting on some 18,000 crores at the end of Q1. That's what some of the numbers which are coming in at this point in time.
I'll in fact go straight back to Gaurang. Gaurang, how do you expect the margin clip to be, and what do you sense is leading to that margin miss?
What I could guess, of course, I would be eagerly waiting, Harsh, to listen to the verbatim of the management. Possibly some kind of a one-off expense or a large part of capex that they're planning, which they have mentioned over the last couple of quarters in terms of focus and thrust on the QC, that is quick commerce, Harsh. And believe me, Harsh, this was the business which they took over, which the market did not expect to contribute the way it has started to contribute, but we remain extremely optimistic. So I think a large investment, or possibly in a pipeline kind of an investment going into the future. But yes, I would love to hear it from the management as the PC takes place later on in the day.
Surely it's food delivery all the way, actually. 621 crore of PBT contributed by food delivery versus the 549 crore they did same time last quarter. Obviously on a slightly smaller base, but on a 15% sequential higher base, they've done nearly 15 to 20% higher on that PBT number. So that's contributed well. It's essentially quick commerce, which has failed to pick up, or rather you've seen a decent pickup there as well in terms of PBT contribution. Another extra 100 crore of PBT contribution is what quick commerce has done in this quarter versus last. And on a base of around 2,400 crore of additional revenue, which they've done on quick commerce. So broadly, that's how it's shaping up. Stock now in the green, just about in the green for Eternal. All right, Gaurang, thank you so much. We'll let you go on that note. Thanks so much. Devarsh, we touched upon some of the Devang, I beg your pardon. We touched upon those platform companies, Devang. Just quickly give us a sense. How should one play platforms, therefore? Paytm came out with numbers as well. There's Swiggy, there's Eternal. Would you avoid them altogether? Would you buy selectively? How would you differentiate between the two?
Honestly, what we have done so far is that we have generally been avoiding. We are looking at the change in perception, the change in terms of numbers, the change in valuation parameters, and how some of these companies have now started to look profitable. Honestly, if I go back to the theory that we run, we look at the opportunity size, we look at the market share of the company, we look at margin of safety. Now here, whether the margin of safety is there in terms of companies delivering quarter over quarter, are there more slippages in terms of their achieving their numbers, or are they missing their numbers? That's where I think most of the companies right now, after this 2-year correction, almost from September 2025, we have seen a plethora of mid and small cap businesses and even certain micro cap businesses going through huge correction, where there are cash flows, where there are earnings, and where there are numbers to drive about. The ROE, ROC is also great. So we probably want to, at this point, nibble into those companies rather than getting into such trades where there is a little bit of more hope rather than numbers. So that's the caveat that I'm taking into. Of course, I know I can probably miss out on the platform companies, but there are a lot of new age companies. And by new age, I don't mean the typical new age who burn cash, but the companies which are into new platforms like HVDC, power automation, manufacturing, engineering, stamping, casting, lamination, semiconductor allied, data centers. I think a lot of such companies are still available, cryogenic equipments. And these are sectors which are 10, 20, 30, 40,000 crore. The entire sector is of that size. I think here there are chances to grow sectors at 3x, 4x, 5x also. So we are probably focusing more on this type of businesses rather than getting into platform companies where probably there can be 12-15% type of growth, but not the phenomenal growth that I'm talking about.
What about other companies, within the banking pack, PSU banks? We saw PNB coming out with good numbers. The street is now penciling in good numbers coming in from SBI as well. What kind of expectation you have from SBI?
Sajid, yes, I think the expectations from the PSU banking pack especially has been very strong. I think most of the companies have done very well, including SBI, to probably clean up the books. I think they are ready to go and probably lend more. We are looking at a lot of the private banks also raising FCNR deposits, also a little bit of low-cost deposit for some banks are also in the pipeline. And what we are also seeing is something, the credit growth expanding, the private capex coming back. The public capex has always been there for the last 5, 7, 10 years, but the private capex is also coming back. So my sense that somebody wanting to play the corporate capex story can also play some private banks and some PSU banks. As I said, whether this will be 18, 20, 22% compounders, no. But can this between 10 to 15% type of compounding? Yes, it can be a small part of your portfolio, the PSU banks particularly.
I want to quickly also touch upon some of the takeaways from the letter that Eternal has disclosed. What they're saying is for food delivery, growth and margins are not a trade-off. They're saying both can compound together, and they believe that the business is growing better, not because they are buying growth, but because the quality of growth is there. They believe that there is scope for margin expansion along with the top line growth that comes their way. This is food delivery, of course. On bistro, and this is the interesting piece, they believe that bistro is an entirely new category. They are going to be spending a lot of energy on bistro going forward. The customer traction is purely price driven, and price driven traction without structural economics tends to resolve itself, is what they're saying. It's not a restaurant. They're calling this a food manufacturing system optimized for freshness, speed and consistency. Last off, with regard to Blinkit, and that's the other big takeaway, right? They are investing heavily. They're saying quick commerce is not an asset-light business, and they're saying that as long as there's healthy ROC, which they continue to see, they will continue to invest. And that's the other key takeaway where Blinkit is concerned. The capex per store currently stands at 2.5 crore. Working capital is around 12 days of NOV, and the EBIT margin is around 4% of NOV. So at 4%, that implies a pre-tax ROCE of 41.7% is what they are suggesting. Blinkit will likely start clocking, or does clock. Really, that's the conclusion.
And what's interesting is, they've added 200 stores in the quarter two, so the total store, quick commerce stores trend now goes up to 2,443, and like growth of really 44% on a quarter-to-quarter basis for the quick commerce part of it, actually. So that's something which is interesting in this. But the net order value for them has fallen marginally on a quarter-to-quarter basis, and
the average order value,
the net average order value,
yes,
from 525 to 518.
That's also because of the new stores opening. There's a 10% increase in store count.
Could be.
So maybe that's some perspective. But Kunal, specifically on charts, Eternal versus Swiggy, right? I'm trying to get a sense. There's been some outperformance first by Eternal, and then following Eternal, there was a move by Swiggy as well, right? In terms of stock price action. One looking more attractive than the other, if at all?
So far, Eternal looking very attractive as compared to Swiggy. But then, Swiggy was one of the stocks which had fallen down by more than 40%, post its listings. I think the stock had gone back towards 230 or 240, which was the recent swing low for Swiggy. It's now coming back into a resurrective move. The stock is trying to challenge back the levels of 270, 280 zone. Time and again, you see with the last, I think, 2-3 weeks, the stock has been testing this band of resistance. Volumes have increased. The participation levels have upped for Swiggy on the other hand. But Eternal, I think when you look at this, the stock has broken past about the long-term averages. You've seen almost like a 30% recovery for Eternal from the recent lows of 210 to 15. The stock had it in the start of 2026 towards the recent high of 300 approximately. So after this 30%, 40% up move for Eternal, of course the stock looks far stronger as compared to Swiggy. But then it looks like that the space is evolving quite well. The lows and the major sell-off which we had seen for both of these stocks, in 2024 second half and 25 a good part. That I think that pace of selling is now behind, and we are looking at a formidable base on the long-term charts.
Okay, the other one is M&M Finance. And Devang, I know we've spoken a little bit about the financials, but I want to touch upon this story because, 2.5% ROA is seriously impressive, right? Coming from M&M Finance in what's expected to be a little bit of a tough year, right? Monsoons have gotten a little delayed. Rural spend is obviously strong, so no concerns there, but just from a weather perspective.
Yeah, I think very clearly we have seen a lot of NBFCs showing good traction the last 2-3 quarters, and I'm not restricting myself to M&M Financial's quarterly numbers only this time. Yes, I saw the numbers, very, very impressive. But most of the companies which are maybe in consumer finance or companies which are in auto finance, tractor finance, I think they have shown a marked bit of improvement. And that's why when I said that better than banks, there are NBFCs and there are other companies, my meaning was companies like Chola Finance, companies like Sundaram Finance, M&M Financial, even L&T Finance to a certain extent. I've not gone through the numbers of a lot of this, and some of them are also pending. But my sense that NBFCs could probably present you with a very good opportunity rather than banks. So while the cost of funding have dropped, if monsoon picks up the way it has picked up, I think there are all chances that NBFCs can also outperform the private banks per se.
How are you looking at it on charts, Kunal?
So I think M&M Finance is evolving as a very good chart, as a potential breakout. We were discussing this yesterday, that the stock is on the verge of those breakout of 350, 360 barrier. It's been actually a flatline move when you look at it from the 2022 or 21, 22 highs for M&M Finance. But then, those range has been very, very expansive for the stock. You'd seen almost a 400 plus, 420 plus for the stock price 6 odd months back. And the recent low, the lows in 2023-24 for the stock was around the 300 level. So that range is quite steep for the stock price. I would sense that it's available back at that mean point. So, when you look at it from the last 4-year perspective, the stock at 355-ish kind of a zone, I would say that it's come back to the mean. The second important point is that the entire NBFC stroke, the financial services basket is looking quite attractive. You've seen many stocks evolving back or coming back into their own. Bajaj Finance, for example, I think is the prime stock, which tends to give a strong leadership hint across the space. You've seen names like, Chola Finance, Shriram Finance, AB Capital, L&T Finance, etc., doing spectacularly well for themselves in the last 6 odd months, 12 months as such. So I think the entire basket looks attractive. There could be a good scope for M&M Finance to perform at least in line at par with respect to many of its other peers.
How are you looking at Bajaj Auto on charts? 6% more.
It's a very strong chart for Bajaj Auto. I think almost a week back we highlighted the buy call on Bajaj Auto when the stock was breaking about the 10,000 levels. This was at a point when the stock was coming back into a very good recovery. 5 or 6 weeks of underperformance for Bajaj Auto prior to that. Now I think Hero MotoCorp is a similar chart, 5-6 weeks of underperformance. But I would say that this could be a good breakout for Bajaj Auto. The big pattern which we are identifying on the charts is a cup and handle pattern spread across the last 1.5 years for Bajaj Auto. So right from the time frame 2024 highs for the stock and then that sell-off which had happened for Bajaj Auto, we are seeing a major formation being established into the stock. And cup and handle patterns on the stock prices generally have very strong positive effect for at least another 3 to 6 months. So very bullish on Bajaj Auto from the entire auto pack at current levels.
No, so Bajaj or Hero, what should one go out and buy?
Bajaj is a momentum stock. Hero could be something which you can bet on if you're looking at trying for the underperformers to play a catch-up.
How do you look at TVS then?
See, TVS, of course, that's also another stock which has done very well post results. But the 2 days of price action post the results, then the stock seems to now have plateaued out. In fact, I was looking at the intraday charts, and there was a point when the stock, I think, was up 3% or 4% intraday at the start. It had hit that 3 sigma Bollinger band. So when a stock hits those 3.5 foot sigma Bollinger band, we generally expect the stock to come back towards some sort of an extreme and calls in for some sort of a cool off. So maybe over the next couple of days, there could be a tepid reaction to TVS Motors, but those dips, if it comes by, should be taken as a good buying opportunity.
And what about the dip in pharma? Should you go out and buy?
Individual pharma names, I think Sun Pharma is still looking very attractive, but the other stocks like Cipla, Lupin, etc., I would still be a little bit more watchful.
Devang, pharma, auto, would you bet on any of those?
Auto, surely. As I said, I was listening to Kunal talking about the Bajaj autos. I would not recommend anything, but of course we like the space. We like even the conventional four-wheeler space, which has shown since the GST cut has shown marked bit of traction. So normally people said that this will just fade out in the next 2-3 months, but it's seen quarter-over-quarter, month-over-month growth as well for most of the four-wheelers, and even these two-wheelers who came up with good set of numbers look interesting. So auto, yes. Pharma will be very, very selective. We like some MNC pharma companies. We like niche diagnostic space a bit. We like the hospital space, but we don't like the pure play generics pharma. So we have tended to ignore that, and I don't see any merit for buying those type of typical large caps. But otherwise, we like healthcare as a space.
Hugely benefited if that's the trade you've played, Devang. But thank you so much, Devang. We'll let you go on that note. A minute to close. I'm going to quickly mark out where we're settling in at. It's obviously been a tough day. It's been a tough day right from the get-go. Around 180 odd points shaved off the index. 0.1% lower. Very similar chart pattern to yesterday, right? When you're looking at it intraday, you're seeing pressure from, but today the differentiator is you're seeing pressure from a breadth perspective. 39 to 40 declines against 10 advances. That's looking very shallow in terms of the breadth. Interglobe, DRL, Geofinance, Infosys, Ultratech, some of the names being the biggest losers. And then you have SBI as well thrown into that list. Bajaj Auto, Nestle. Those numbers didn't get time to discuss, but 3% and very strong numbers from a Nestle. Later this week, we'll have Tata Consumer as well, and that stock has perked up 1.5% in trade. Eternal now up 1%. Post the numbers coming out. Again, decent set of numbers from Eternal, but Bajaj Auto really standing out, right? Those numbers coming at us now taken fast and therefore need to keep up. In terms of broader markets as well, you saw pressure today, 1.3% lower on the Nifty small cap, 1% lower on the Nifty mid cap. Nifty IT down 1.5%, the Nifty Bank down 1.25%. Well, it was pressure across the board, frankly. You had the heavyweights also sulking. Realty was down 2.7%. PSU Banks down 1.8%, led by SBI. The Nifty IT index down 1.6%. I spoke about that. The Fin Nifty, the Nifty Pharma also down 1.3%. Nifty Pharma was expected to be the top sectoral loser. It's not played out as badly as one would have expected versus the overall market. FMCG was the only saving grace after Nestle's numbers. 0.1% higher on the Nifty FMCG index. Auto mild gains, of course, given Bajaj Auto, and then there's a little bit of consumption, or rather the Nifty consumption index gaining just a wee bit at close. On the Nifty 500, just very quickly trying to flag off some big movers in trade today. 16% lower on Bandhan Bank. Numbers again, Oracle down 7, PG Electro down 6, Avas Financiers again numbers down 6, 28 basis point decline in margins for Avas. Ola Electric down 5.5. Saregama, Tips, India Mart, all down 5% plus. I wonder if Tips is down 5% plus even now. Likely so. Data Patterns down was the one which bucked the trend, 12% higher. M&M Finance up 8. Bajaj Auto among the top 3 gainers on the Nifty 500 index, up 6. RR Cabel, Chennai Petro, Crisil are just some of the other gainers, but it's a very tough market. 410 losers to just about 90 gainers. Can we flip tomorrow, Kunal? Really, that's essentially the question. And what if we slip below 23,800? What next?
So the only positive which we've seen today is the put call ratios come back towards below 1 for the markets. And historically, when the put call ratio falls below 1 after a zone of 1.6, 1.5, the market generally sees a bounce back. The second silver lining is for the markets is that the net market breadth, advances minus decline, whenever that number reaches 1,1800 in favor of one side, the market generally tilts back again opposite into the next subsequent day. So at least on these 2 data points, it looks like that maybe tomorrow could be a day of reprieve or some sort of a bounce back on the indices.
Okay. All right. Totally timed out on this edition of Closing Trades. Thank you so much, Kunal, for joining us. We'll let you go. Sajid, myself, and everyone who puts this show together, it's a thank you from all of us here.